that gives me $1,000 risk barrier or leeway that I want from my entry, and that's what I want to limit my risk to on any trade that I'm going to enter. So there are some reasons, some analysis that you can make. You can get a little bit more active if you use a dollar. It depends on your trading style, how much you want to be in, how much you want to be out, all those kinds of things that you may have to determine your own parameters as you get into it. And that, again, will depend on each person. It might be a little different. Okay, we're just going to look real quickly here at a couple of things here, again, on the related to the mini oil contract. The first thing that I'm going to recall is that we had this sideways movement. Remember, we were up, we went sideways, so logically we are near the top of this range that we have had. The next movement, most likely, that we're kind of expecting would be a move to the downside, just simply because of the way markets work. They tend to go up and go down or sideways. They kind of have this rhythm that they kind of go through. They alternate between the two. This case, this black candle that you see there, that was on May the 4th. We had a predicted low where the arrow points of 85.13 that day. So what we're going to use, that is our 85.13 minus $2, and we're going to be trading, we're going to be selling the market at 83.13, somewhere right in there. Maybe not be the precise spot, but 83.13 is going to be the spot. And I am also going to use that 85.13, our predicted low, as our limit of what we're going to accept. That's $1,000 limit, where I'm going to put my initial stop, because I don't want to go beyond that, risk more than that $1,000 on this trade, because I may not be right. There are some times when you're going to be wrong. You're going to have to take the loss, move on to the next trade. So you may not be right. You want to make sure you have that limit on your risk in place as you get into the trade, and before the market gets away from you and causes you a big loss. As the market moved down, it moved down pretty steadily. In this particular case, dropped pretty sharply, and as it moved down, you are going to be moving your stop below. You're above the predicted high. You're going to keep it. See it get down to perhaps about somewhere right in here. I think about the May 6th date where you had this low somewhere. I don't know if that's precisely the May 6th, but when you get to this candle right here where you had the predicted high at 82.11, you had your $2 on it, you put your stop at 84.11, and so immediately, after getting into the market within a day, you're able to move your stop down so that in case the market does turn against you, you will not have lost everything. You'll increase the ability to absorb the risk if the market does turn up. You could also, a couple of other things when you're using a swing trading strategy, there are a couple of possibilities here where you could, for example, the market drops enough and it does it so quickly. Any one of these places in here, you might have wanted to be able to add on a contract. Once you have this first contract that you're trading, you made some money on it, you have some money in your pocket, you may want to add on a contract. Do not do, for example, short one and then decide, okay, I'll short two more and then I'll short four more. That would be a reverse pyramid, and that's disaster if the market turns against you. But if you add on a contract, something that you can control, keeping in mind that everything that you do, every time you make a trade, you have to think about the risk aspects of that trade. So, you can work the market that way. A second thing that you can do is you can determine for whatever scale you want. You can say, okay, I'm going to set my potential profit targets at some point, a given point. I will take a drop of, let's say, $2,000. That's good for me. I don't want to take any more risk. In this particular case, you had a situation where the market was moving lower. It was getting down. If you recall, when we drew our line here before, we were somewhere in this vicinity right here. We're at $68, $69, somewhere in there. That was pretty much the bottom side of the range that we were talking about. As the market approached that, you might have decided, okay, I am satisfied. I don't, as it gets below 68, I don't think it has that much more potential. I'm going to take some profits. Or perhaps on that big down day that you see there, where you have that long candle, that big tail, you see there, well, that might have been a day that you might want to take some profits. Not, I know you're supposed to let profits run, but it's not always a bad idea to take some of the profits, at least for some of the positions, off the table and not put that money at risk, especially when you have the market's money and not necessarily your own money at stake. Okay, now we've ridden the downtrend, we've worked it out. We've said that we're going to let it go, going to let it go all the way down. We're going to let it work its own way down. And we come down here. We have a predicted high on this particular case. We're on May 26th. The predicted high was 69.39, so we are going to be out at 71.39. That's going to be kind of our turning point. And that occurred again here. That's again, not be the exact precise point, but at 71.39 the same day. If you recall, when we got in way back up in here, and the amount that we sold at 83 roughly, and we're out at 71. So we got about a $12 profit, $12,000 on the full size, $6,000 on the mini. Pretty good trade. Pretty good trade, to withstand some other small losses that you inevitably will occur from time to time. So we are in a situation also where we have this turn here, where we could take a long position. Sometimes you'll get a signal to get out. It's hard to make two decisions in one trade, but sometimes you have a day where you get out of a market, but it also indicates that this is the start of a new market. So you may have two different signals, two different clues during a given day. And so we would assume that if in this particular case, let's say that we got in at that point, now we are kind of reversing. We know the market was at the bottom of the range. It's going to bounce off that range, or theoretically it's going to bounce off that range. And so we're going to have a long position at 71.39. We'll just keep that position right in this vicinity right here, 71.39. And again, we're going to be keeping our stop in mind as we go along. We want to not let a market kind of get away from us. And if it is a extended downtrend, we don't want to get a situation where the market, we're long and the market keeps going down. We don't want to get, too far gone. So we're going to keep our stop in the vicinity of that predicted high. Now, as that market does move up, now we have an opportunity to start to use some other clue as to where to get out of the market. In this case, we had the predicted low that moved up, and as it moved up, the question is, where do you keep that stop? You can put it above the predicted high. You can keep it at the predicted low, rather. We're talking predicted low now. Maybe you were out, maybe you're not stopped out, but you might have stayed in that trade using that initial stop for a long time. Or you probably, if you're following the strategy closely, you're probably going to look at this particular black candle